All right. So, like I said, this is a monthly briefing intended. So, I call it the State of the Union, kind of give a big picture overview. I'll discuss kind of the economic trends, what the progress is made towards recovery, which I think right now is especially pertinent and it should be informing our investment decisions. And I'll talk about exactly what I'm seeing now and how that will affect us in the next few months and how we look at the market and um, you know what we should be looking at going forward. So, all right, a bit about myself. So I'm from the Boston area originally. Grew up north of Boston. Lived there my whole life, and in college, I got a ROTC scholarship out of high school. So I ended up tracking into the Air Force, going a aviation route. So I went to Pensacola, Florida for flight school, and then I ended up tracking the B-1 bomber. So I got about 2,500 hours in that jet, and I made multiple deployments to the Middle East and Afghanistan, Iraq, and Syria. So bit of an interesting, unique background there. While I was active duty in the Air Force, my main base in my career was in South Dakota. So I moved there in 2011. I bought my first property. So I bought a duplex and I did the house hacking route. So I lived in one side and I rented out the other, and it covered all my bills. So I didn't know the first thing about real estate investing, cap rates, or anything like that, but the numbers worked, just kind of back of the napkin type of underwriting. And then that's kind of what kicked off my interest in real estate. So I ended up buying another property a couple years later, and then another property a couple years after that, and so on. So that was my intro into real estate and what started my interest. Um, Shortly thereafter, I got involved in the crypto space. So I'm an early cryptocurrency investor. I started buying Bitcoin in 2013, and I got a lot of shit for it at the time, but seems to have worked out in the long term. And that's kind of afforded me some freedom to pursue real estate full time. So I founded Mach 1 Equity about a year ago, and I'm pretty excited for the future, especially in our current environment. I think we're going to see some good opportunity over the next 1 or 2 years. So, all right, we'll start off with jobs report. So this is a monthly report put out by the Bureau of Labor Statistics. Kind of the background of any economic discussion is the jobs report. So May actually had a surprise gain of 2.5 million jobs. So most analysts were expecting a 7.5 million jobs lost, but we actually gained jobs. So, but if you look at that chart on the right, so you can see from the recession, we gained about 22 million jobs over the last decade, and we lost all of them in a matter of weeks. So we've clawed back 10% of that, but we still have a long way to go. So leisure and hospitality, that was the worst hit sector, but it had the most gains last month, so that somewhat makes sense. The government, that had the worst month last month, so they shed almost 600,000 jobs, mostly in the education space, and that is a shaky segment going forward. We'll talk about that in a future slide. But the bottom line is, so they brought the unemployment rate down from 14.7 to 13.3, so it dipped about 1.5%. However, by the BLS own admission, they have some pretty drastic errors within their report. So they're saying their true unemployment rate is actually closer to 16.5%, which is about a 3% dip from the previous month, which was 19.5% was the true number. So, and the reason is that when they do the surveys and they talk to people, the thing is there's multiple unemployment numbers and ways to calculate unemployment. So this is the most commonly referred to unemployment that you'll see in the news. And the way that it's calculated is it discounts people that are not looking for work, and it doesn't really incorporate people that are underemployed. So if someone goes from being an engineer to bagging groceries, that person is drastically underemployed, but they're still just considered employed per the unemployment number. So I think that's a lot of what we were seeing over the last couple of years is we had these record low unemployment numbers, but it sort of doesn't tell the full picture of, a lot of people had jobs, but they were kind of shitty jobs. So, and that's still a factor. So the true unemployment 16.5, but when you start incorporating the fact that a lot of people weren't, like, if you were a waitress and you lost your job during this thing, of course you're not looking for a job because all the restaurants are closed. Where are you going to look for a job? So they're not considering those people part of the labor pool, and that skews the numbers significantly. So, there's other numbers out there that people think are better indicators, and those are up in the low 20%. So, 1 in 5 people, pretty significant. So we still have, 25 to 30 million people unemployed is the bottom line. Going forward, the consensus is that 40% of those people are not going to get their jobs back. So, 80, 90% of those people expected it to be a temporary layoff, but, 4 in 10 people are in for some rough times ahead. So that's when you're talking 30 million people, 40 million people, it's significant, right? And a lot of these numbers don't calculate undocumented workers, which there could be upwards of 10 million of those. So, we're in pretty dire times. I mean, you can see there that picture is in Kentucky last week. They had set up kind of an impromptu unemployment office at the Capitol after people on unemployment started doing protests outside the Capitol because they weren't getting seen and weren't getting serviced by the unemployment office. So people were waiting in line for 10 hours a day, and they would cut the line off at like 9 in the morning, and those same people would be in line till 5, 6 at night or whatever it was. So there's definitely a lot of offices that are overwhelmed with the amount of unemployment because they're just not built to handle this type of scale. As I said, it's primarily low-wage workers that are affected. So that middle class and above sector of the country hasn't really felt it in comparison to the lower class, lower wage workers. So there's definitely a lot of disparity there. Going forward, weekly claims still came in at like 1.5 million last week. So that's not a good sign. For context, that's almost 3 times what the record was back in like 1982. The largest unemployment week was like 600,000. And then of course we've crushed that. So we're still on a outsized pace for weekly claims. And then total throughout this, over 46 million people have gone through that unemployment system in one way or another. So still pretty significant. So going forward, I think July to September is kind of the do or die for the recovery. If Congress and the government can step in and alleviate some of this and actually take some drastic action to adjust this. Otherwise, it's probably going to be too little, too late. It's probably already too little, too late in a lot of ways. But so here's the different sectors that were affected. Like we talked about, leisure and hospitality, the hardest hit, but they had the biggest recovery. But you can see across the board, each of these, they saw a big spike in May, but it's still just a fraction of what was lost. So we're starting to see that we're in the recovery zone, but it's kind of trickling in so far. And then, as I had alluded to with the government jobs that were lost last month, so that could be kind of a dark horse that could be a real problem going forward, because other than Vermont, every state is required to run in the black. They can't run at a deficit like the federal government, but they have the ability to collect taxes. The problem is right now, sales tax, real estate taxes, income taxes, everything across the board has been gutted and collapsing. So we're seeing this huge budget gap across the country. It's like $1 trillion or something. So unless the federal government steps in and kind of bails out some of these state governments, they're probably going to start doing massive job cuts. And it could be, 5, 6 million people across the country that lose these, safe government jobs, right? So that's definitely a concern going forward as well. All right. Here's some, so throughout this, what's been interesting about the last couple months is economic data tends to be somewhat slow. I mean, GDP is only reported on a quarterly basis. Your jobs numbers are always 3 or 4 weeks behind. So getting real-time data on a weekly basis is tough, other than maybe weekly unemployment claims come in a few days later. So that's pretty relevant data. But here's some charts that just show that April definitely was the bottom, and now we have started the recovery. So you can see home purchases definitely took a slide in April, but this is mortgage applications. So those have rebounded very strongly. Restaurant bookings are a little bit slower. They're trickling in now, but you saw it was at 0 in April. And then hotel occupancy rate as well dipped in April, but now it's recovered slightly, but still businesses aren't really doing business trips. People aren't traveling for their personal vacations or purposes. So some of that stuff's going to be a little bit slower to recover. Consumer spending. So this is kind of the backbone of our economy, right? So you can see it just fell off a cliff in April, dipped 20%, but it did have a 16.5% rise in May. So a lot of people were really happy to see that, but you can see we're still not where we were. And I've seen consensus saying anywhere from 1 to 3 years to really get back to where we were in terms of spending. Or I even read a report today that said 2030, so like a decade to get back to where we were prior to all this. So that's really at the crux of this, is how long is it going to take for consumer spending to get back to previous levels, because that's what's going to drive growth and that's what's going to support jobs, basically. So, and you can see there on that chart on the right, that's comparing May of this year versus last year and the change in spending across those different sectors. So obviously, clothing stores, retail, those are down significantly. Gas stations, it's largely because, one, people weren't driving during this because they're not going to work, and two, the gas prices were gutted as well. But you can see the more essential type businesses actually did better. So specifically food and beverage is one. I mean, people go to the grocery stores and they're stocking up because they're afraid of a food shortage or whatever. And then food prices actually went up like 3% during all this. So we've seen sort of this almost niche inflation within the essential food and beverage sector. All right, so that's kind of the economic update. I think it's just really important to get a sense of where we are. So now we know, hey, we've started this recovery. It's just kind of going to be a slow bog, and that's really going to inform our decision going forward when it comes to real estate. So specific to the housing market, existing home sales are actually down in May versus April, almost 10%. They're down 27% on an annual basis, which is the largest decline since 1982. So a huge drop off in home sales, but a lot of that is because real estate just kind of took a pause, right? So people just kind of took this pause when the shutdown began. But inventory slipped like 20%. So basically people just aren't listing their houses right now. So it's really shortened up supply significantly. However, demand has spiked. It's up, according to Redfin, up like 25%. So we see this huge imbalance develop between supply and demand, which is actually prop prices up 3%, which is interesting. Another thing driving that is, as we showed in the previous chart, mortgage applications spiked. So we have pretty much all-time low interest rates around 3%. So in the last week, mortgage applications are up 5%. Refinance applications are up 11%. And then when you look at the year, it's even more significant. So you have a 13% increase in mortgage applications, but an 80% increase in refinances. So everyone is scrambling to refinance right now because we see these record low interest rates, and you can really save a lot of money and cut your payment down by getting a lower interest rate. So people are scrambling to do that, and that's actually propping up rates a little bit. Banks have basically set a floor on mortgage rates because even though the treasuries dumped, which is generally your mortgages are based off of the 10-year treasury note, but as that fell, basically said, okay, well, we're not going to go, you're never going to see an interest rate below probably 2.5%. So, there's only so many applications that a servicer can process. So if they have this influx of refinance, it justifies propping up that interest rate. So encouraging data in May was new home sales were up 16% from the prior month. So we are starting to see some activity. It's just, like I said, it's that lack of supply that is still creating a seller's marketplace. However, what we are seeing is forbearance. So due to the CARES Act, you can put your mortgage, if you're affected by COVID, you can put your mortgage into forbearance and not make any payments for 6 months, but there's a 6-month extension on that. So right now we're seeing almost 5 million people taking advantage of forbearance, and best guess is 15 to 25% of those are expected to not recover and go into default. Now they have a long time to come with a plan and get out of that situation. but that's where we could see some opportunity as those houses go into default and then come on the market. But it's going to just take some time. So real estate's slow moving, and that could be the next year or two, right? So it's not going to be the next few months. I think we're still going to see home prices stay up through the fall, and it'll continue to be a seller's market. All right, shifting into multifamily specifically. So this is specifically more geared towards your commercial multifamily. So a lot of this data is based off of professionally managed apartment buildings, so your larger commercial apartment buildings. But we see so far throughout this, rent collections have been solid. So I put 4 now. We'll talk about why that is. But so you looking at May of this year was only about 1.5 points below last year. And then if you look at June, we're right on track with where we were up through the 20th. So far, it's been essentially a negligible effect on rent collections. People are still paying their rent through this. So multifamily owners are quite happy about that, and it really makes the multifamily asset class look good, justifies it, right? Class C though, Class C, Class D, those are going to be more affected because the tenant base is much more affected by this. Those are your hourly wage earners, and we're seeing that those collections are down 5 or 10%. So that Class C asset is definitely more affected than your Class B asset class, which is more that Goldilocks. Short-term rentals actually surprisingly rebounded, and what's going on there, the trend is basically within 250 miles of a metro, basically anywhere there's nature, lakes, rivers, mountains, people are stir crazy after spending a few months at home. And a lot of people that had to cancel their vacations, they want to do something. So they're going out and they're getting an Airbnb outside the city and, spending a few days out, somewhere secluded and rural that is not around a bunch of people, not in an urban environment. So specifically in those more isolated Airbnbs. But let me see, I got it here. Between May 17th and June 3rd, they had actually higher bookings than last year. So you can see those really rebounded quite strongly. On the negative side though, rents across the country are down slightly. So this is mainly driven by those Class A apartments. They're going to see a dip in occupancy as people flee those more expensive luxury apartments, go into Class B, which is still a nice place. So the Class A, they have to provide concessions to get people to release or sign a lease. Maybe it's a month of free rent or $500 off or whatever it is. So that's going to kind of push rents down. So they dipped $5 in May, and total throughout this, it's I think a $13 drop. So again, it doesn't sound very significant, but it is a reversal. It's the first dip since 2010, and it's probably going to continue that way through the summer. So major gateway markets are the most affected. So San Francisco, probably the worst at an 8 to 10% drop, and then other cities, Oakland, LA, Boston, 3%. So those are more affected, those high cost urban cities. Of note for opportunity zones, so if anybody is involved in an opportunity zone, they've extended some of those deadlines. So if you're not familiar with opportunity zones, that's a whole discussion on its own, but basically it allows people to take capital gains. So if you have a bunch of stock options, say, you can defer those capital gains for the time that you're in this opportunity zone, up to 10 years. So people can put their money into an opportunity zone, defer those capital gains. They can get up to, I think it's a 15% break on those capital gains, and they don't pay any capital gains on the profits from that investment in the opportunity zone. So for people with large capital gains, it's a really good opportunity to bypass some tax obligations, and they've extended up to the end of the year for any expiration date after April 1st. So another negative coming out of this, so the lending environment has definitely tightened. So what I'm hearing most common is 12 months of reserves being required for a property. So that just means you need to raise a lot more money. So it really kind of changes the dynamics of the deal, because now you've got a larger capital account balance, a larger basis that you base your returns off of. So in order to make those numbers work, it's a challenge. So we could see, if that sticks around for a while, we could see that start to bring prices down, and as the market has to adjust to that. Self-storage was a surprising area that disappointed. So their street rates, basically their asking rents for new tenants, have dipped 4.5 to 6.7%. And some markets like Minneapolis saw like a 16% reduction. So I just thought it was interesting. I'm sure they're still doing well in terms of their current occupancy, but the fact that they had to dip those rents after 2 months of this shows that it's always touted as recession proof, but I just thought that was an interesting display of weakness there. All right, so taking all this information, what do we see going forward? So we have seen an increase in renters missing their June payments due to primarily, like I said, that Class C asset class. We're seeing homeowners that are missing their payments or late on their payments. Saw 9 million miss their June payment, and 10.7 million people of those surveyed expect to miss July. So there's certainly some weakness in that area, which could increase. It just is an indication that people are having financial issues, right? So if we look ahead, unemployment, those benefits that were provided by the CARES Act, those are expiring at the end of July. And then, as I said, a lot of those temporary layoffs are going to become permanent. So the bottom line is, although multifamily rent collections have been strong, I don't think we're actually going to see the effects of this until probably September. I think July, people are still receiving those unemployment benefits. PPPs keeping some people on the payroll. And then same thing in August. They're still getting benefits through July, so they're going to make their payments in August. So September, October, that's really the first test for the multifamily market of how exposed is it as a result of this. So unless the government steps in with some other program that could provide people with some help to pay their rent, we will almost assuredly see some weakness in the fall for multifamily. So I think that just highlights for us, if we're looking to buy property, to just be patient. Don't rush into something right now with fear of missing out. A lot of people, they saw fortunes made in 2008, so they don't want to miss the boat this time. And for sure, fortunes are going to be made over the next few years, and we want to be a part of that, right? But I think just being patient, don't get ahead of ourselves, don't get FOMO to allow us to make stupid decisions. I think that there's going to be more opportunity ahead. Real estate's just slow moving. So that's kind of the bottom line. That's the big takeaway right now of all of this economic and real estate data that we're seeing going forward. So, all right, so that kind of concludes the formal presentation. This is my current project in Loveland, Colorado, developing with my partners out there, a medical office building. So we're excited to be moving forward with that. That should be delivered in the fall or winter. So we're targeting either owner occupants or people looking for a triple net lease investment with a very safe medical tenant base. For that industry is just going to continue to see growth and probably additional strength coming out of this with the focus on the healthcare marketplace in general. So this is the presentation of this is the written version, the Mach 1 report. So this is on my website, mach1equity.com, if you want this similar data, but in a written form that you can reference. So, and there's my info. So if we haven't talked before, I definitely encourage you to look me up on my website. You can see my Calendly there, calendly.com/mach1equity. So you can schedule a phone call with me. I love to just talk to people about real estate, what their individual goals are, and see if there's some way I can help you achieve your goals. And also, I'm producing ongoing content. So this is going to be a monthly market update that I do just to inform you guys, 20, 30-minute market update to keep you ahead of the trends. And then every other week, I'm also doing a webinar on different topics within real estate. So I think the next one is investing with IRA and retirement funds. But if there's a topic that you guys want to hear about, then let me know, and I can make that happen. I can do the research for you guys or teach you whatever it is you want to know. So if you guys have any questions, you can go ahead and throw it in the Q&A or the chat box. and we can talk about whatever you guys want to talk about if there's any questions you have. I think, it's going to be, like I said, the next few months, just seeing how this all pans out. But I do think I'm excited for the next few years. I mean, obviously, it's a very sad time for our country. We're going to be going through a painful time on the whole, but I do think there's going to be the opportunity that comes out of this. So we just want to make sure that we're positioned and ready to go when that shows up. Yeah, more. So there's definitely some opportunity, some resources on how to use IRA. Yep, you do want a CPA that's kind of knowledgeable on the benefits of solo 401k versus self-directed IRA. There's some tax implications that come along with that. So if you're doing a self-directed IRA, you could be exposed to what's called UBIT. So it's unrelated business tax. Your CPA is trying to talk you out of it. Yeah, that's no surprise. People that aren't familiar with that stuff, they get scared out, and it's sort of the industry has an incentive for you to keep your money in the system. So if you just think about why we have to come up with these ways to kind of circumvent the system, because think about, why is it that you get penalized for just taking out money of your IRA? It's your money, you earned it. Why is the government penalizing you? Well, it's because they want your money to stay in the stock market. So the Wall Street basically lobbied for it to be written that way so that they can keep trillions of dollars in the stock market and have our money to play with. So I can shoot you some resources. The best thing to do, honestly, is to directly call or in the last 20 years in the stock market. Yeah, I agree. I basically pulled out all my money out of the stock market, and I'm putting it in the real estate. In the next few years, the other thing we haven't even discussed is inflation. So that's something that's going to be actually much more significant than it has been in the last 30, 40 years, because the Fed and Congress is printing so much money, and they're putting so much money into the system that inflation is going to start to kick in 3 to 5 years, and you're going to want to be holding real assets, whether it's gold or real estate or even Bitcoin. A lot feel is anti-inflationary. You want to be holding something that is going to benefit. So real estate, it's going to generally appreciate in line with inflation. Your rents are going to increase in line with inflation. And your debt, if you have long-term fixed rate debt, now you're paying it off with cheaper dollars. So basically you've deflated your debt, and you're paying it because you're paying it off with those cheaper dollars. So there's a lot of advantages to holding real estate in terms of inflation. And it's usually just mentioned as an afterthought, but yeah, it's going to be more significant. Yeah. So I mean, you can't. Yeah, Moira, that's not enough. It's not gonna cut it going forward. I don't know if you saw my multifamily fundamentals webinar from 2 weeks ago, but it's on. When you get the replay for this, you'll receive the YouTube channel. And if you look for last week's multifamily fundamentals, I talk a fair amount about returns and what you actually need to be getting. Spoiler, it's about 18% is what you should be targeting for returns. So real estate, that's actually very realistic. And that's what we target. I'm not even gonna entertain a property that isn't earning me 7-8% cash flow a year, and probably looking at 2x over a 5-year period, maybe 1.8 or something. But that's generally what we're targeting for investment properties. We want a combination of cash flow and appreciation. Generally, we're forcing that appreciation by doing upgrades, improvements, and raising rent. So that's kind of how we're give some resources. Yeah, so the best is going to be like a custodian. So you have to go through a middleman for investing those funds. So I can shoot you some resources on that, because if you talk to them directly, that's really like the source data on how to do it. So I don't have it off the top of my head, but I've got it on a list somewhere, so I can shoot you some contact information. You can just talk to them and really get it sorted out, and they can probably kind of point you in the right direction. There's also some podcasts and other webinars, so I can shoot you some of those as well. And like I said, I'll be hosting a webinar specifically on that in the future. So I think any other questions from anyone? Welcome, Todd. Thanks for checking in. You missed it. Sorry. Thank you, Mort. All right. If anyone doesn't have any questions, I don't want to keep you here. We can call it a day. Like I said, this is intended to be monthly market updates, so I try to keep it short. I think we ended up around 30 minutes this time, but yeah, 20 to 30 is going to be probably the target going forward. So that way it's pretty quick, not sucking up. Most webinars are, an hour, hour and a half. So I know that's a big time burden for a lot of people, especially if, you're working and you got kids and a family. That's a lot of time, and our time is valuable. So, and this information is particularly valuable when you're getting it on a recurring basis, so that you start to understand the trends and how those are developing. As we spoke about right now, the trends are still kind of telling us, hey, opportunities around the corner. It just hasn't quite got here yet. So, all right, guys. Well, I think that'll do it. Thanks for checking in. Enjoy your weekend, and hope happy investing.